Look, you've been spying on me for quite some time, and I've mostly ignored it. But if we're going to continue to do this, I feel like I have to be honest. And I have a confession to make. I don't really like diversification. Now, I know this puts me at odds with financial advisors, and you may be thinking, hey, this YouTube guy, he doesn't deserve a thumbs up. He doesn't really deserve a way to go in the comments. At best, he doesn't know anything. And at worst, he's some kind of a scam artist. Now, in my defense, I'm not selling you mutual funds. I'm not selling you anything currently. I don't even have enough views or subscribers to get some of that sweet YouTube money. I have no motive to mislead you. I still may be an idiot though, so do be on guard. Look, when people talk about red pill, blue pill, what do they always bring up? Women. It's like they're obsessed. The real blue pill is in finance. So if you could stop simping for 10 minutes, we could explore what you choose to ignore. So what is diversification? I'm glad you asked. In this context, it's when you disperse money across different investments. So you might choose to put your money into stocks, which is what this channel is all about. You might invest some money in CDs, which are certificates of deposit, which are only marginally better than holding cash. And then there are things like bonds, real estate, gold, paintings, hockey cards, whatever you want. There really is no end to potential investments. Now you might be thinking, hey stranger on YouTube, I don't think hockey cards are that good of an investment. And you're right, that's my point. Diversification has some advantages and it has some drawbacks, and that's what I want to look at. Because there are certain groups that want to sell you on an idea of diversification that I don't think is necessarily true. And we're going to look at an example from my own life which I think raises some questions and puts up some red flags. And it really gets you noticing the motives of certain groups. But first, let's look a little closer at diversification. I'm not against diversification. Let's get that out of the way. It's not totally bad, but you have to at least know why you're doing it. What are you trying to achieve? Is there another way to achieve the same results? I think these are good questions to ask yourself, and do ask yourself. Don't let somebody else answer these questions for you. Do think about what you're doing, because this is your money and your future. So the purpose of diversifying is to protect yourself. It's meant to lower the risk involved with investing. Suppose you bought Luckin Coffee at $50 a share in January of 2020, and you held it until July 24th, today, of 2020, when it's now worth $2.55 a share. And imagine that was your life savings you put in there. You'd be very upset. So again, the purpose of diversifying is to protect yourself against the dangers of bad investments. Now on the other side of the coin, when you diversify out the risk, you most assuredly diversify out all of the potential gains. If you buy 3 companies and one goes up 5%, one goes down 5%, and one doesn't do anything, what have you gained? So the old risk to reward issue is at work. The more risk you take on, the more potential reward or potential disaster. Look, I don't want to bore you, so let's get into the story. When I first started working, I made just enough money to scrape by. I didn't have enough money to invest anything. Eventually I got a job where I made enough money to buy a TV, buy a computer, then I started saving. I got married, and my wife and I kept saving. And when we had $25,000, we went to the bank, and we said, hey, we want to take out the biggest loan we could possibly get. More money than I could ever imagine saving. And then we dumped every last penny into Tesla stock. Just kidding, we'd be rich. No, what we did was we bought a home. This was all the money that we had in the world and all the money that we could imagine ever making. And no one brought up diversification. Not once. We had 2 jobs between the both of us. And they said, how much money do you make? And I said, I make this much money. And they said, okay, we'll loan you this much. And I said, well, what about what she makes? And they replied, we don't care about what she makes. It's based on what you make. Now, they've never said why, but I've theorized that it's because women will generally get pregnant and stop working. So they base the loan off the man's salary because he'll work until he dies. And that's the meaning of mortgage in the old French death pledge. So 1 job, 1 house, all my current money, all my future money. How is that diversified? So then after a little while, my wife and I save up some money, and we go back to the bank, same bank, and we say to the person, we have $1,000 and we'd like to start investing. They don't say, okay, let's open a self-directed investing account. No. They say, okay, we have mutual funds you can buy, but first we have to find out your risk tolerance and your time horizon. So let me interject. Those are valid questions and are very much linked to each other. Your risk tolerance is mostly based on age, and it's very important. If you're investing money you're not going to need for 40 years, then you have a very high risk tolerance. If you have money that you're going to invest and you need it in a year because you're going to retire, you have a very low risk tolerance. Similarly, your time horizon is very important. If you're going to be retiring in a year, then you're going to need some percentage of your money very soon. Or even if you're young and you're planning on going to school or buying a house, you're going to need some percentage of your money in the near future. So you can see the need to have access to that money. Taking time to consider how much money should be in short-term investments is a good idea for the financially conscious. So you need to ask yourself, what kind of investor am I? Can I take on a lot of risk? Or is risk going to be a problem for me because I need this money soon? And similarly, does seeing my account balance drop so much scare me so much that I would rather just put my money in my sock? It's important to know before you get started what your risk tolerance and your time horizon are. But anyway, back to the story. So after finding out our risk tolerance and our time horizon, they begin talking about diversifying. And that's largely the point of mutual funds. They pick a bunch of stocks for you within one mutual fund, thereby diversifying your money across different criteria, and you buy all those different stocks at once when you purchase the mutual fund. Or you're at least buying the market's perceived value of the mutual fund. Because the mutual fund is bought and sold on the market just like a stock. And therein lies another issue. What even is the difference between a stock and a mutual fund? Most stocks are one company, but when a company grows, it starts buying up other companies. So look at Warren Buffett's Berkshire Hathaway. It owns some companies completely and other companies it owns partially. Like it owns Geico completely and it owns just a portion of Coca-Cola. But it's a stock. But the price of Berkshire Hathaway fluctuates and you can buy it at different prices on different days. Same with a mutual fund, but a mutual fund owns many companies. It may own thousands of companies, but it still fluctuates in price. The real difference that I can see between a stock and a mutual fund is voting rights. You have no voting rights when you buy a mutual fund, and they also charge a fee. That's what you're trading for: diversity and the illusion of risk reduction. But anyway, back to the bank. So the first issue is, why is diversification so important now? It wasn't when I got the loan for the house. Nobody cared about it then. One job, one house, all my money. It was a complete non-issue when it came to my death pledge. And the second issue is, why does diversification matter? It's only $1,000. It's not enough money to even be worried about the risk. I lose $1,000 if my phone breaks. I think that at some point, diversifying your money is just absurd. If you have a small amount of money, it's absurd. And the third issue is buying multiple companies all at once. I've taken $1,000, diversified it across 40 companies in a mutual fund, and bought them all on one day at just random prices. Hasn't buying companies at just random prices added more risk than it's deleted? The new risk created is that a bunch of those companies are overpriced and possibly poor quality. I must be able to do a better job on my own. And I think that's the case. You can do a better job on your own. As we talked about earlier, things like real estate, gold, bonds, these are forms of diversification. And those are each very large subjects. So we'll mostly just be staying focused on the stock market in this video. And in my opinion, a mixture of cash and stocks offers just a ridiculous amount of diversification. So let's look at that. One of the most basic ways to diversify is to invest in different industries. Often different sectors of the market will move as a group. Semiconductors may all go up one day, or the banks may all fall on one day. Pay attention to that kind of thing if you're looking to diversify your portfolio. Owning 3 companies in the healthcare sector may not be that diversified. So you might consider buying one great company in the healthcare industry when the whole sector is at a low. Owning larger companies often diversifies out a lot of risk in itself. If you buy a restaurant down the street from you, that's pretty risky business. Put all your money into one location, and if it doesn't do well, you'll suffer. On the other hand, if you buy Apple, they sell a variety of items across the world, and they're constantly growing their business. They don't just sell iPods either. They sell phones, music, software, watches. They're starting to compete with Netflix. They're in countries all over the world, and they are diversified. And there are a lot of other ways to diversify, but I didn't include a lot of them because mostly they're junk. Things like diversifying based on market cap is generally a waste of time. The whole sector will get hit, big and small caps. Buying commodities like gold isn't a good idea for the long term because they're geared toward making quick trades, not investing. In my opinion, for the most part, the quest for diversification is problematic for most people. They don't really consider what about it is valuable, so they just try to blindly diversify. And if you're buying mutual funds to gain that diversity, you're probably losing because of the fees and the poor prices. What about diversifying on your own? What if you completely ignore the advice of mutual fund salesmen and start investing and diversifying on your own? It's doable, but an individual investor trying to follow 40 companies is absurd. However, you don't need 40 companies. What you need to do is redefine the way you think about protecting yourself. And that brings us to the first of risk reduction tips, knowing what you own. I do stock research. I know how much time goes into finding a good company and then looking at it in depth. I don't think it's very practical to own 40 companies unless you're not very concerned about how they're doing. 5 to 10 stocks is a pretty reasonable amount of diversity in my opinion. I think it really allows you to focus on undervalued, high-quality stocks and then follow them closely. These are real businesses. Owning a portion of 5 of the best businesses in the world is a pretty secure prospect. And remember, diversification is not the key here. It's just a form of risk reduction. Risk reduction is the key. So what are some other forms of risk reduction? No more. This almost sounds silly, but it's far more important than diversity for risk reduction. The reason there's risk involved is because we don't know everything and we don't know what the stock market is going to do. So 100% of risk comes from not knowing. Diversification is meant to guard you against your own stupidity. So then it makes sense that to know more would be a form of risk reduction in itself. The more understanding you can gain about an asset, or in this case the stock market and individual companies, the better off you are. Or in real estate, the more you know about a particular market in an area, or about what will increase the resale value of a home, or what a damaged foundation looks like. All of that knowledge will take out a massive amount of risk from the equation. It's sort of funny because when you leave your money with a professional, they immediately try to diversify out the risk as if they're saying they don't know what they're doing either. Price. Price alone doesn't reduce risk, but buying a company that has value and buying it at a low price is the most surefire way to reduce risk. And you don't want to buy a company that just has a low PE. That's not what I'm talking about. Look at when the China trade war was popping off. Apple went from 225 down to 150 and was recently up at 325. And this is what I mean. Apple's a solid company, but there's way more risk involved with buying it at 325 than there is with buying it at 150. The price brings risk. And buying one great company at a good price has to be infinitely better than buying a bunch of companies at just random prices. And if you do buy great companies at low prices in a few different sectors, then you are diversified. And very closely related to the price is the quality of the company. And I'm not saying just buy any company that's on sale. There's no greater assurance of risk reduction than buying a quality stock. Even if you buy a good company at an inflated price like Apple at 325, there's reason to believe that they will eventually justify that higher price, meaning that its business will grow. Buying a mixed bag of good and poor quality stocks in a mutual fund is just always a bad idea. Going back to the Luckin Coffee stock example, I wouldn't touch that stock at $1.25 because the quality just isn't there. And you can check out my video about investing in Chinese stocks if you want to find out some of the reasons why. So to wrap this all up in a neat little package for you, in my humble opinion, diversification is mildly valuable in small amounts. But overall, I think it's been exploited by mutual fund salesmen to make you believe that you are incapable of following vast amounts of stocks and thereby forcing you to believe that mutual funds are the only answer. They've stripped you of your dignity and made you completely dependent on them, thereby giving you the financial blue pill. If you work at one job and have ever bought a home, diversification is probably not something you're very concerned about. And neither is anyone else. That is, until somebody wants you to buy their crappy funds, and then it becomes paramount. And most funds underperform the market. So don't allow salesmen to mentally abuse you, and don't give in to being lazy, because neither of those are a good look. Hope you enjoyed my little rant. Goodbye. If you like what you saw, give me the thumbs up and subscribe. And don't forget what I told you.